Hey, what's up, everybody? It is Wednesday, November 23rd. Tomorrow is Thanksgiving. So we had another positive day today. Yesterday, the fiscal flows, it was a net positive of 15 billion. So that wiped out the drain of the prior 2 days. Yesterday on my video, I said that Monday we had like a 7 billion drain, and last Friday we had like a 4 billion drain, so it was 11 billion drain. But then yesterday, Tuesday, we had a 15 billion net positive flow, so that replaced the drain plus, an additional 4 billion. And today, which I don't have the data on because it runs 1 day behind, but today was a Social Security payment day, so we probably had, a 25 billion, maybe a little bit more net positive flow. So everything's looking real good as far as fiscal flows are concerned. And I hope you guys are starting to get the picture now, because, I've been pointing this out for months and months ahead of time. I've been telling you when these tax drains are going to occur, and that's going to be problematic for the market and for risk assets. And then I tell you ahead of time when the positive fiscal flows will start to replace whatever drain occurred from those taxes, and that lifts the market up. I mean, it's all pretty easy to understand. You can ascribe these moves to whatever you want, the Fed and monetary policy, and be totally insane about this and get into the same kind of neuroses and psychosis that all these monetarists get into. And now they're looking for any kind of language that the Fed is going to pivot. But it's all a function of these flows. It's all a function of this net government spending. And that's, like I've said many times, that's the first derivative. That drives everything. What comes off of that, the second derivative, the third derivative, that's all a function of these flows going into the economy. And that's why I've been saying that as long as net spending, in other words, deficit spending, remains in effect, you are adding to the swimming pool. You're raising the level of net financial assets in the economy. And that's a positive thing. And the only thing to really be concerned with is the rate of that addition. In other words, is it happening very rapidly like we saw during the COVID time when you had these massive stimulus bills one after another? Or is it happening more slowly? Or are we subject, or are we seeing a contraction like what we saw in the first half of this year, of 2022? And I said that was going to stabilize. That contraction was going to come down to a level, but it wasn't going to continue to, keep on contracting, because the major components of spending, there's four things basically. You're talking about Social Security, you're talking about Medicare, you're talking about Medicaid, and you're talking about the military. And while the military is discretionary, Congress pretty much treats it like a non-discretionary expense. They just, whenever you need the money, and we just got, another $4.5 billion for Ukraine, and that's actually spent here. I mean, that goes to arms manufacturers. It basically gets spent here. But anyway, so that's what it's all about. There can be periods where there's a slowdown in those flows, and the market will react to that. There are periods that actually see drains like 4 times a year or 5 times a year. You got April 15th, the tax day. You got 4 quarterly corporate tax payments that are kind of cyclical, that the market reacts to. But other than that, it's a net positive flow. All right, let me, and just on that note, let me end on that note, because there was one Fed member today. And by the way, as long as I mentioned the Fed, today the headlines were, I guess, focused on the FOMC, the minutes from the last Fed meeting. When was that? I mean, it was just this month, right? What was it, November 2nd or the 4th or something like that? The last Fed meeting. So everybody, again, the crazy monetarists, they were parsing through the language. And I guess, you know, the determination today was that the Fed is kind of like getting a little bit softer on their interest rate outlook. I think there was something in there. I saw something in there. And again, I don't pay a lot of attention to this stuff, because to me, monetary policy is really irrelevant. It's all about these flows. You know, I understand that monetary policy drives behavior in the short term. I get it. But I mean, I'm not, you know, I mean, to sit here and to try to invest based on, you know, kind of guessing people's behavior. And it's one thing to say, okay, you know they're going to do something because the Fed is hawkish or the Fed is dovish, but then you don't know the time frame in that. For example, I think there are probably a lot of investors who are still either short the market or in cash because they want to see or hear a definitive statement by the Fed, maybe a policy statement in one of the meetings saying, okay, we're going to stop right now. And I'm telling you, by the time that happens, you know, the market is going to be much higher. It's already much higher from the October lows. And there's people waiting around. And I happen to think some of this rally right now, I think also has to do with some of those investors are starting to cover short positions or slowly get back into the market. I think it's going to be interesting to see, like tonight, the weekly AAII sentiment survey comes out, you know, and it's been kind of gradually moving towards a more bullish. It's still, the bullish sentiment is still below the historical average, but I have a feeling like we could finally pop up. It's been a year that it has been negative or below the historical average. So we might finally move up above that. But anyway, you know, I can't sit around and try like a psychologist and try to gauge the exact moment or close to the exact moment when people's expectations or sentiment shifts. You know, I'd rather just look at these flows and just understand that, yeah, it might be a little bit early on a position or whatever, but that's fine. That's fine. I have no problem with that. But anyway, there was somebody from the Fed today said, you know, it's going to take time for savings to build up at these higher rates. Okay? And, you know, I read this, and again, it's just a glaring example of cluelessness, of a lack of understanding. I mean, interest rates have absolutely no bearing on the level of aggregate savings, the total amount of savings. Okay? I may save more because the rate is higher. You may save more. But in the aggregate, that means all of us. This is what they call a fallacy of composition. You know, it could be something that could be true for an individual or one, you know, one entity or one instance, but in the totality, it's not true. So if we all save, like I've said this example so many times, like if I don't spend my money at the grocery store or the movie theater or the restaurant or going on vacation trips, then, you know, the grocery store and the movie theater and the restaurant and the airline companies, their income and their savings goes down. Okay? The only way, and that, again, that's a Fed official who was saying this, the only way that aggregate savings can increase is that some entity in the economy has to spend more, has to dis-save so that we have more. And in our case, it's the federal government. They have to you know, it doesn't matter what the interest rate is. What matters is if the federal government runs larger and larger deficits, those deficits of the government accrue to the non-government. They end up being the surpluses of the non-government, right? If the government sends you a check and on its balance sheet, say it sends you a Social Security check of whatever, you know, what's the average, $1,500 a month? It sends you a $1,500 check. Okay, so on their accounting, it's a minus 1,500. On your accounting, it's a positive 1,500. Your balance went up. The government's balance went down. That's the only way. And the perfect example of this is, you know, during the pandemic, when rates were zero, savings went to a record high of $6 trillion. Look, here's a graph right here. But again, what's fascinating about this is that you have a Fed guy, and he's not the only one. I've done numerous videos and commentary on comments made by Neil Kashkari, who is the president of the Minneapolis Fed, who said, like, during the pandemic, he was like, I'm not that worried because we got a big stock of savings because people didn't go to movie theaters and restaurants. And I'm like, what the hell? This guy's like, come on, man. You're a Fed president. If I don't go to the movie theater and the restaurant, then the movie theater and the restaurant owner doesn't get my income and their savings go down. It's, you know, it's like a plus on one side, a minus on the other side. Somebody or some entity has to add those additional savings. And that, you know, it doesn't matter what the interest rate is. The interest rate could be negative 20. And if the government is, you know, really expanding its deficit, you're going to see the balances, the financial balances of the non-government, that's us, it's going to go way, way the freak up. Okay? Way up. All right, so I wanted to mention that. The next thing I want to talk about, we got the weekly EIA, that is the Energy Information Administration's weekly petroleum status report today. A little bit weak on the demand side, I have to say. Gasoline demand was down, distillate demand was down, jet fuel demand was down. We saw a draw in crude inventories, and now, by the way, the year-over-year surplus in crude inventories, that is gone. That is gone, and what's fascinating, or shocking, I should say, about that is that that surplus is gone despite a record amount of drawdown in the Strategic Petroleum Reserve. Which, that's not going to go on forever. Okay, so I'm just saying, right now, it's kind of a bearish short-term environment because, you know, we've seen inventory build, although, you know, the last 2 weeks we've seen inventory draw, and now that year-over-year surplus is gone. But once that SPR draw, and also I should say that it was a big jump in crude imports in this week. And even with those imports, guess what? Inventories were down. But gasoline inventories were up. They're still down year over year. Distillate inventories were up. Those are still down year over year. Demand was I would say slightly on the weak side, but I'm sure it's going to pick up in this week's data because people are traveling now. You know, they're expecting record, the TSA is expecting record traveler throughput at the airports. So jet fuel demand is going to be up, gasoline demand is going to be up, etc. What else was there? Oh, exports were kind of soft. We had now the last 3 weeks, if I'm not mistaken on the data, maybe a little bit longer than that, a slowdown in net exports. It's about 1.27 million barrels a day. You know, that's down quite a bit. I think it's like at a 3-month low right now, and that could explain the dollar's weakness. Okay, the dollar is very I should say the dollar is very strategically tied to, and I spoke about this in a video a couple of days ago about U.S. exports. You know, U.S. now is a net exporter of petroleum. So when exports are going up, you know, that's usually bullish for the dollar. Now, we're still a net exporter, but the level of net exports has come down, and now you're seeing, you know, there's been some weakness in the dollar over the last few weeks. Not sure how that's going to end up, but I suspect that we're going to see a pickup in petroleum exports again. I think this is a temporary feature. So anyway, that's it. You know, I mean, look, I think that going into, I said this yesterday, going into mid-December, into maybe early January, mid-December, December 15th, we get another quarterly corporate tax payment. But you know, it's also the holidays, so people tend to dissave. I mean, you know, that's we tend to see a high amount of spending during the holidays, so that could offset some of that. But I was looking at patterns from previous years, and you could get some market hesitation, maybe a modest pullback going into that time period. But I would just mention that if the rhetoric on the Fed side starts to get a little bit less hawkish, because, you know, the monetarists, you could predict their behavior, then the rally's just going to continue. But overall, big picture, you know, we're in a bullish situation, and 2023, folks, that looks to me like super bullish. And I'll tell you why. Because we'll really start to see the interest income transfers from the rate hikes. Those will really start to be kicking in. And in 2023, there's going to be a very significant increase in Social Security benefits because of the cost of living increase, the inflation increase, basically. So fiscal in 2023, it's going to be huge. It's going to be, and I think that's going to make a really, really strong market. So you gotta get long now. This is the time. I mean, this is, you know, what's funny is, like, most people are going to wait till next year, and when the market's already running. I mean, now's the time to load the boat. Load the boat. All right, that's it for today. Tomorrow's Thanksgiving. Happy turkey. Maybe I'll make a video tomorrow. If not, see you on Friday. Bye.